The world has never owed this much. Not in any empire, any era, any system. Governments, corporations, and households now carry over $315 trillion in debt, about 3 times the size of the entire global economy. Every year, roughly a tenth of everything humanity produces doesn't build roads, cure diseases, or raise living standards. It just services interest. Not the debt itself, just the cost of keeping it alive. Here's the part almost no one says out loud. This debt is not going to be paid down. It was never designed to be. The system is built so the principal lingers indefinitely, while interest flows forever upward, from workers to creditors, from indebted nations to financial centers, from the bottom of the pyramid to the top. For decades, the solution to every slowdown has been the same. Cut rates, pump liquidity, print money, backstop banks. Whatever pain threatened to appear was quickly anesthetized. Deep recessions were blunted. Market crashes were softened. Job losses were mitigated. On the surface, it looked like progress, like we'd finally outsmarted the old boom and bust cycle. But we never did the opposite. We never took our foot off the gas when times were good. We never let weak companies fail. We never allowed bad investments to be cleared out. Instead, we layered stimulus on top of stimulus. Cheap money on top of cheap money. The result is what we see now. A global economy addicted to low rates, inflated asset prices, and entire sectors full of companies that only exist because money was almost free. And now, the tide is going out. Growth is slowing. Rates are no longer pinned near zero. Inflation, while off its peak, is still too high for central banks to slash rates without consequences. At the same time, the pile of IOUs has become so enormous that even a mild downturn threatens to trigger something far more dangerous: cascading defaults. Some commentators call this the recession we need. They argue that a downturn will clear out inefficiency, kill the zombies, and redirect resources into healthier parts of the economy. In theory, that's what recessions were always meant to do. But this isn't a controlled burn. It's a forest fire in a world that stacked the trees too close together. To understand why, we need to zoom in on what a recession actually is. In the simplest terms, a recession is when an economy produces less than it did before long enough that we can't dismiss it as noise. Output falls, hiring slows, unemployment rises. Businesses and consumers retreat. There are 2 broad ways this happens. One is a supply shock. Something physical stops production. A pandemic shuts factories. A war blocks trade routes. A natural disaster wipes out infrastructure. We can see the damage. We can point to the missing pieces. The other is a demand shock. Nothing physical is broken. The machines work. Workers are available. The networks function. But people stop spending. Firms stop investing. Credit tightens. Fear spreads. So even though we could produce more, we don't, because no one wants to risk getting stuck with the bill. That second-kind demand collapses has a brutal purpose. It exposes which businesses were only standing because money was cheap and optimism was high. In good times, almost anyone can look successful, borrowing to cover losses, raising capital on hype, selling a story instead of value. When confidence disappears, those illusions break. Companies that were never truly profitable, never truly efficient, suddenly no longer have access to easy cash. They go under. It's cruel, but the resources they were consuming eventually flowed to stronger, more productive businesses. That's what happened after speculative bubbles in the past. Hype-heavy ventures died. A handful of real durable companies survived and built the next era on the ruins of the old. At least, that's how it's supposed to work. But something changed. We stopped letting recessions do their job. Every time the economy hinted at trouble, central banks flooded it with cheaper money. Every time markets stumbled, policymakers rushed in to catch them. Instead of allowing the cycle to clear out deadwood, we propped the deadwood up. Zombie companies that should have failed years ago stayed alive by rolling over debt at low rates. Governments kept borrowing because it was painless. Households piled on loans because asset prices kept rising and everyone else was doing it. All of that postponement ended up in the same place: $315 trillion in global debt. Debt isn't just a big number. It's a claim on future income on work that hasn't happened yet. Every claim has to be serviced. Interest has to be paid year after year. When that interest bill is about 10% of world GDP, it becomes a drag on everything else: investment, consumption, innovation. More of the pie goes to the past, less to the future. For a while, ultra-low rates made the weight feel manageable. Governments issued bonds at 1 to 2%. Companies financed buybacks and acquisitions at 3 to 4%. Families took out mortgages at rates that looked like generational bargains. That illusion ends when rates rise and growth slows at the same time. Debt that looked harmless at 3% becomes lethal at 7 or 8. A company that could cover interest in good times suddenly can't. A government that could handle its debt service now faces fiscal crisis. A household that could just afford payments finds itself underwater. Over the next few years, trillions in obligations need to be rolled over at higher rates. Some will manage it. Many won't. And when defaults start, they don't stay isolated. A failed borrower is never alone. Behind every bond is a pension fund, an insurance company, a bank, an investment firm. If their losses are big enough, their own promises crack. They sell what they can, pull in credit, and retreat. That ripple hits others, and the pattern accelerates. We've seen a smaller version of this before one major institution goes down, and the damage ricochets through the financial system faster than governments can react. Only now the web is even more complex. The derivatives stack even higher. The debt far larger. And this time, the firefighters are already exhausted. In the last major crisis, central banks had room to move. They could slash rates several percentage points and unleash massive asset purchases. Governments had lower debt loads, enough credibility to borrow heavily and splash stimulus across the economy. Today, public debt ratios in many rich countries are at or near wartime levels. Deficits are huge before a recession. Rates are already high enough that cutting them back toward zero risks reigniting inflation. So the old playbook cut, print, bail, repeat doesn't work the same way. If policymakers try to save everything, they risk the currency. If they defend the currency, they let more failures happen. Either way, the pain doesn't vanish. It just moves. There's another problem: politics. Trust in institutions is badly damaged. Populations are angrier, more polarized, more suspicious. In the last major crash, there was still some grudging acceptance of bailouts. Do whatever it takes to stop the collapse, voters were told. Many believed there was no alternative. Now, patience is gone. Another round of giant corporate or banking rescues would ignite a backlash that could be worse than the recession itself. Leaders know this. They are operating with fewer tools, less trust, and a much more fragile social fabric. So we arrive at a brutal crossroads. If they intervene aggressively, they risk inflation, currency debasement, and further loss of trust. If they don't, they risk a deep, grinding downturn, high unemployment, waves of bankruptcies, a lost decade or more. People like to say, we need a recession to clear out the excess. Maybe, but this isn't a surgical procedure. This is a system-wide strain test on top of record leverage. Recessions don't only kill the walking dead. They also crush new, healthy businesses that happen to be fragile. Families who are only just getting stable. Workers whose only mistake was being in the wrong industry at the wrong time. And in the aftermath, the pattern we've seen so many times repeats. Those who already hold assets and liquidity buy distressed property companies, and claims for pennies on the dollar. When the dust settles, ownership is even more concentrated than before. The story is always sold as necessary pain for long-term healing. But the pain and the healing don't land in the same place. So here we stand. A world with $315 trillion in IOUs. An economy dependent on cheap debt that no longer exists. Central banks trapped between inflation and collapse. Governments with limited fiscal room and fraying legitimacy. Trade, conflicts, and geopolitical tensions adding sparks to dry tinder. Some call this the correction we deserve. In reality, it looks less like a correction and more like a reckoning. Debt made the system bigger. Debt made it look stronger. But debt also made it brittle. We spent decades refusing to let small fires burn. Now the forest is overgrown, the winds are picking up, and the tools we used last time aren't guaranteed to work again. This isn't about panic. It's about clarity. If you understand how we got here, you understand why the next downturn won't behave like the old ones in the textbooks. You understand why small shocks now have the potential to become systemic crises. And you understand why the people telling you it's just a normal cycle are either lying to you or still clinging to a world that doesn't exist anymore. If you want to keep unpacking these patterns, how we got here, what happens next, and how power uses crisis to reshape society, subscribe. Because in the Lost Archives, we don't just watch the cycle. We learn from the wreckage it leaves behind.